Welcome to the Lock Zone with the Colorado Mortgage Team.
Hey guys, welcome to the Lock Zone. I'm Clinton Sistrunk, your mortgage engineer. All right, so we've got some really interesting things happening in the interest rate world. So I don't know if you guys have been watching it. Treasury yields are back up. We had a little pullback last week and we're back up. Now let's put some context around this so you guys kind of understand what happens. Okay. Well, a lot of people are confused right now. The Fed has cut interest rates twice, once in September, once last week, and both times rates have gone up. And that's counterintuitive to most people because most media outlets start pushing that, housing's getting cheaper, rates are coming down. And that's just not true. So when the Fed cuts interest rates, it is affecting short-term securities. So things like auto loans, credit cards, HELOCs, the prime rate on your bank changes. You probably get a notification from your bank that says, hey, we adjusted the prime rate right after the Fed cuts rates. That's where it impacts things. The mortgage rate market is long-dated securities. Long-dated securities are a predictive mechanism that's trying to predict the future. And so most of these moves are already built in by the time you get to the event, that event being the Fed cutting rates. So the mortgage market's trying to predict the future and what's going to happen in the future with the Fed. Now, let's talk about that so we can kind of predict and see where we might go. So first, let's just look at a chart of the 10-year over the last 12 months. So you can see on this chart right here is where we were before the Fed cut rates the first time. And so we had a massive spike up after that. And people say, well, why is that? Well, because the market started pricing in a Fed cut as soon as the Fed started talking about it. And you can see that right here where rates came down. Now, we just had another Fed cut right around here. If we zoom in, let's just go to a 5-day chart. You can see Fed cut. We had a little bit of a pullback. Now we've come right back up. We came right into CPI data. Now, what is CPI data? CPI data is a measure of inflation. So the Fed has a mandate. They're trying to do two things. They're trying to stave off a recession and they're trying to stave off inflation, which means they're trying to keep inflation down and keep the economy strong so we don't go into a recession as best they can. That's what they're doing with their Fed rate cuts. So when they're looking at predicting things, they're looking at those two metrics. Now let's check those out because there's a lot of interesting data in those metrics. All right, so first, let's just talk about GDP. Okay, this is a chart of the last 5 years of GDP. It comes out every single quarter. Now, everybody's been talking about, oh, we're in a recession. Things are so tight. Things are expensive. Everybody's suffering. But the reality is that we haven't been anywhere close to a recession for a long time. A recession is defined as 2 quarters of negative GDP growth. The last time we saw that was right here in COVID, and we immediately snapped back out of it. Now, we did get close in 2022. We printed a negative number. You remember the yield curve was inverted. Everybody was talking about that. They thought for sure we were going into recession. And then we started to ramp up. So last quarter just came out. We printed 2.8 growth. Before that, we printed 0.3 and 0.1, 0.6. Now, if you look at this, we started dropping growth, 4.4, 3.2, 1.6. The Fed cut rates. They said, oh, man, we're coming down. But then we kind of flatlined out of it. And we're not anywhere close to negative GDP growth right now. That's just the reality of it, okay? So the Fed, when they're looking at GDP growth and whether we're in a recession, they don't have a reason to cut rates. All right, so let's look at this. This is CPI. So this came out from Routers today, and it basically said that CPI that came out today was up modestly as expected. Now, first line right here in the article, consumer prices increase as expected in October, and progress towards bringing inflation down has slowed since mid-year, which could result in fewer interest rate cuts from the Federal Reserve next year. If inflation was dropping off a cliff, we could make the case that, rate cuts are okay. There's no reason right now for the Fed to have to lower interest rates based on inflation. That's what this is telling us. Now, there's a big aha, a big gotcha that I don't hear people talking about right now. But it's a major input on what's happening in the interest rate market and why rates are so resilient in the face of these Fed rate cuts. So let's take a look at one more data point real quick. All right, so this is the Department of the U.S. Treasury, and it's basically saying, hey, we're borrowing money to fund the government. Mortgage-backed securities and treasuries trade on the open market like a stock. And so people are buying them. And this is how the government raises money, government debt, right? The government right now needs a lot of money, or they think they need a lot of money. So they're borrowing a lot. Well, when they're needing to borrow a lot of money and people aren't willing to loan them that money in the form of buying those bonds and mortgage-backed securities, then they have to raise the rate that they're willing to pay on that debt to entice people to come in and let them borrow that money. Right here, this just came out October 28th. They're forecasting how much they're going to borrow. And you can see during October to December, they're expecting to borrow $546 billion. We go to the first quarter of 2025, January to March, and that's going to jump to 823 billion. That's a pretty big jump. Now, why do I bring this up? Because if they need to borrow more money, but people aren't willing to give it to them, then they have to raise the rate they pay to bring that money in. Now, what's competing with treasuries right now? Well, you've got the crypto market, which is screaming higher. We just hit 90,000 on Bitcoin today. So is there a perception that you can make more than 4% on the 10-year by putting your money into crypto right now? Also, what's happened since we had the election? The stock market has taken off. And so can you get a better return in the stock market? What has gold done over the last few years? It's been screaming higher. So the precious metals are a good space. These are all competition with the government trying to raise debt. Now, why are they raising debt? And they need to raise a lot more than this. It's because the new prestige policies that are going in place from the new administration. Let's just look at one thing: immigration. We have a new immigration czar who said they're going to remove all these people from the country. They're talking about millions of people, shipping them all back to their countries of origin, right or wrong, whether you agree with it. That is an extremely expensive proposition that the government's going to have to spend money to execute. And they said, basically come out and said, we don't care what it costs. We have no idea what it's going to cost. It's just going to happen. So in anticipation of that, the Treasury has to raise money to pay for it, which means more supply, higher interest rates. These are all working against the only thing that's working to lower interest rates, which is the future Fed cuts, which seem to be getting pushed out. So there you go. There's where we are on the interest rate market. It's not super exciting if you're looking for lower interest rates. Today, I would be in a locking bias if you're anywhere within 30 to 60 days, and we're going to leave it there.